Yeah.
The card being circulated.
Oh, good, I have not signed it yet. Okay. Okay.
Let's give it like
Okay, we're going to just give people 3 more minutes. In case there are some folks who went to 50 Broadway by mistake. Okay, so just give us 1 minute to. To really inform us by drawing on the expertise and generosity of folks like those who are here with us today, to really learn about and probe some of the issues that we're confronting as we are working through the tax reform issues. So today we're going to concentrate on circuit breakers and other kinds of transition relief, and we are really delighted and very, very grateful to our experts today. So starting on my left, Adam Langley, who is the Associate Director of Tax Policy and Data Initiatives at the Lincoln Institute for Land Policy. His research focuses on state and local finance, primarily on property tax relief programs, and business tax incentives, nonprofit payments in lieu of taxes. Adam knows a thing or two about New York, having worked in the New York State Assembly, and has written a series of works for the Lincoln Land Institute that have been just incredibly helpful as we've tackled this question. So, Adam, thank you so much for being here. And John Anderson is with us. John is the Baird Family Professor of Economics at the University of Nebraska-Lincoln College of Business. And his academic research is incredibly long, more than 100 different articles and books and chapters and reports. He's written one of the leading textbooks on public finance. He served as a senior economist with the President's Council on Economic Advisors and has been an advisor to states and local governments all around the country. And he, too, is associated with the Lincoln Institute for Land Policy. And I want to say not just on this transition and circuit breaker issue, but on so many issues, the Lincoln Institute has really been the go-to source for whenever we need information. So we are really delighted to welcome them. We're going to start by just introducing the members of the commission, and then Professor Anderson and Adam Langley will give us an overview, and then we will open it up to questions from the commission members to each of them. So, Francesco, why don't we start down with you?
Yes, Francesco Brindisi, Office of Management and Budget.
Jacques Gia, Commissioner of Finance.
Alan Capelli, member of the commission.
Mark Shaw, co-chair.
Vicky Bean, co-chair of the commission.
James Parrott, Director of Economic and Fiscal Policies at the Center for New York City Affairs at the New School and member of the commission.
Ray Majeski, City Council Finance Commission.
Latanya McKinney, City Council Finance Director.
So I leave to you which of you would like to go first.
Okay. Well, it's a privilege to be here to talk with the Commission about property tax issues. As you've noted, we're both affiliated with the Lincoln Institute for Land Policy in Cambridge, and the Lincoln Institute is the premier organization doing work on these topics, and so it's a real pleasure to be here with you. I've got some general comments about the main topics of this afternoon, and then I'll turn it over to Adam, and then we'll go to Q&A. So let me begin by saying I think the Commission's objectives are laudable. I think making the property tax system in New York City fairer, more transparent, and simpler. Let's move this a little bit away from us here.
That's not the solution.
Okay. All right. Making the system fairer, more transparent, and simpler is a laudable goal, a set of goals. And my review of the New York City property tax system reveals a high degree of complexity that you're familiar with, in part due to the complex portfolio of real estate you have in the city, and that's to be understood. Despite that reality, the commentators and analysts describe the current system as mystifying and
On that note.
I took note of the Furman Center 2012 report that said a property owner's final liability is complex, but it can be reduced to 9 basic steps, which didn't give me much reassurance.
Single digits.
So, but just by way of general comments, best practice in property taxation involves, first of all, a market value standard for assessments for all classes of property. That's the gold standard in the world of property taxation. Secondly, transparency in assessments for property owners. Thirdly, frequent updating of the tax roll and assessments. And fourth, effective and impartial appeals process. So those are the features we're usually looking for in designing a property tax system to be as fair, as transparent, and as simple as possible. With that basic backdrop, let me turn to talking about 2 basic ways in which property tax relief is generally provided, either through an income tax-based mechanism or a property tax-based mechanism. I'll start on the income tax side, and these are usually described as circuit breakers, and let me tick off some pros and cons of circuit breakers. First of all, circuit breakers target relief to those that need it most, and it provides it's capable of providing substantial relief in a cost-effective manner. Rather than spreading property tax relief across a broad range of property owners, you can target it to those who need it most. When property taxes rise relative to income and trip the circuit, using the analogy of the electrical circuit breaker, then relief kicks in. It allows for means testing of that property tax relief and could perhaps also be means tested with respect to net worth as well as just annual income, although most circuit breakers just look at income. You've already got a mechanism that exists with the New York City Enhanced Real Property Tax Credit that is completed when people fill out Form 208 and file that either with their income taxes or independent of their income taxes. So the mechanism exists for doing something along these lines, although the parameters of that tax credit we could discuss later on if you'd like. You can make the property tax credit refundable if you connect it with the income tax If it's a refundable credit, it can make the income tax system more progressive than it would otherwise be, and that's an attractive feature of property tax relief delivered this way. And I would point out, as thinking as an economist, it would also help to draw people into the formal labor market when you administer the property tax relief that way. There's an incentive to file an income tax return in order to get the refundable credit rather than to work off the books. And so there is that benefit as well. In terms of the cons of property tax relief delivered this way, there are several. It's difficult to front load the tax relief with the circuit breaker. People often are in a situation where they've got to pay their property taxes throughout the year, and then they file their income tax return after the year is ended in order to get their credit. There are some ways to try to work around that, but that's one of the difficulties with this kind of mechanism. It's hard to front load because it's by nature backloaded. Also, the property tax relief that you're providing is less transparent to the property owners. It's coming through an income tax credit, and it's there because their property taxes are high relative to their income, but it's not as directly connected to property taxes as far as the property tax payer is concerned. It's less transparent as property tax relief. And finally, it may induce some taxpayers to demand more local public services because the tax price for those public services has been reduced for those that receive the credit. So whether that's a significant factor to consider or not depends on how broadly you're spreading the property tax relief through this mechanism. If I turn to property tax-based relief, there are both pros and cons there as well. You can target relief to specific groups of property owners or for specific land use purposes. You can provide exemptions, abatements. You can classify the property. All of this you're familiar with, but those are attempts to try to target relief in ways other than income-related ways, which the circuit breaker does. You can deliver property tax relief through a circuit breaker independent of the income tax system, and some jurisdictions do that. Some state circuit breakers are designed that way. So you can have a circuit breaker that's not connected to the income tax as well, but you've got to find a delivery mechanism for that purpose if you're not going to piggyback on the administration of the income tax system. But if you provide many types of relief, it leads to complexity and non-transparency in the system. So if you're giving homestead exemptions or elderly or disabled or veterans exemptions, you've got tax abatements and rate limitations and assessment increase limitations. It becomes a very complex system and ultimately non-transparent. I took note as well in the Furman Center 2012 report. They've got a table that lists 18 different categories of property tax expenditures that currently exist, with abatements and exemptions providing quite a bit of relief to nearly 800,000 property owners, nearly $3 billion in tax relief. So in aggregate, there are a lot of programs providing small amounts of relief, but it's not targeted in the way that a circuit breaker could target that kind of relief. So there's quite a bit already being spent on property tax relief, but it's not targeted the way a circuit breaker would. Let me say some brief things about tax deferrals as well, if that's topic you'd like to discuss. So deferral programs provide temporary relief, although I would point out that it comes at a price to both the taxpayer and the local government. Deferred taxes have to eventually be paid, and usually with interest. So who pays the tax in the meantime? In some state deferral programs, it's the state government that makes the local governments whole temporarily until the deferred taxes are paid, in which case the state is paid back, in effect. If the state doesn't step in and do that, then the local government just goes without the revenues for some period of time, unless they've got the capacity to borrow against those anticipated deferred taxes. That's one possibility as well. But tax liens are placed against the property, and in terms of reasonable interest charge. From an economist point of view, it should reflect the opportunity cost of funds to the local governments. Thirdly, best practice would indicate taxpayers should have some kind of skin in the game. They should be paying a portion of the tax. Anywhere from 3 to 5% of income might be reasonable, with the excess tax above that being deferred for eventual payment, either payment directly or through a lien placed on the property. So when the lien is placed on the property, that secures repayment in the future when the property is transferred. So there are examples. The Lincoln Institute has a nice spreadsheet that shows 30-some states have deferral programs, and they differ in their various characteristics. The one that I would point to as exemplary is the Minnesota Senior Citizens Tax Deferral Program. It's limited to seniors, but otherwise it's a reasonable deferral program to look at as an example. Third, let me talk about state and local tax deduction limitations and some of their impacts here in New York State as well as New York City. The Tax Cuts and Jobs Act of 2017 limits state and local deductions for those who itemize to a maximum of $10,000. I'm sure you're aware of this. It's a significant binding constraint for people in New York, especially. So I pulled the IRS data just to check for New York State tax filers in the most recent data, 2016. So the average state and local income tax deduction for those who claimed the deduction in 2016 was over $17,000. And then the average real estate tax deduction was nearly $9,000. And so you put those two together, and a $10,000 limitation is what I would call a binding constraint. These are state numbers. These are New York State. I didn't have the city numbers. I just pulled the IRS data for New York State. And you know, it's probably worse than the city, I understand. But the federal deduction limitation effectively raises the net state and local taxes paid for many taxpayers. Although the higher standard deduction mitigates that to some extent, right? The doubling of the standard deduction is helpful, but not sufficient to compensate for those that have high levels of state and local income and taxes and real estate taxes. So taxpayers that are subject to that SALT deduction limitation face higher tax prices for state and local public services. So if you're in a 25% federal marginal tax bracket, for example, the price of local public services, once you hit that cap, have just gone up by 25%. And that affects the demand for public services and the willingness to pay for local, state and local taxes as a result. So if you put that together with any potential property tax increase that might be coming from a reform for those that suffer an increase in their property taxes, they may be subject to a double whammy here with property taxes going up at the same time. They're unable to deduct as much on their federal tax return. So those cover the basic topics that I anticipated you would want to talk about. I've got some references for studies that you can look at if you want to follow up on any of these. The commission or its staff can follow up, but I'll leave it at that and turn it over to Adam.
Thank you.
Thank you. Good afternoon, everyone. It's great to be here today. Really happy to have the opportunity to speak with you. You certainly have a very important task ahead of you, and so I hope my comments will be helpful to your work. So I've been asked to speak about a really critical part of any fair and effective property tax system, and that's property tax relief. And specifically, today I'm going to focus on two of the most cost-effective approaches to property tax relief: circuit breakers and property tax deferrals. Now, I've been researching a variety of approaches to property tax relief at the Lincoln Institute of Land Policy for over a decade now. And that research shows that efforts to provide property tax relief fail as often as they succeed. So it's a really important thing to be careful and do it right. And we know relief is necessary because property taxes are not directly connected to households' ability to pay. So we need assistance for seniors on fixed incomes, people who have lost their jobs, low-income people in areas with rising home values, and so on. But all too often, policies that are presented as property tax relief actually end up doing more harm than good. And these are policies that can undermine the strengths of the property tax without actually addressing its weaknesses, such as limits on the annual increase in assessed values and other policies. But again, today I want to focus on the good news, which is that there are policies that work effectively. And as I said, the two most cost-effective approaches to property tax relief are circuit breakers and tax deferrals. So first, I want to go into more detail about circuit breakers. The purpose of circuit breakers is really to prevent homeowners from being overburdened by property taxes. As John said, the name is meant to be similar to an electrical circuit breaker, which is meant to prevent a circuit from being overloaded by electric current. These programs are meant to prevent people from being overburdened by property taxes. And they are intentionally a targeted program, specifically focused on people paying the highest share of their income in property taxes. And the benefit of this targeted approach is that you can provide really substantial tax relief for the most heavily burdened households while still carrying a lower overall tax expenditure than a broad-based program like a homestead exemption or a tax limit that provides a little bit of tax relief for everyone, even those who don't necessarily need property tax relief. So there are a couple of different approaches to circuit breakers that are used by states, but the classic approach would be called a threshold percentage of income that property taxes must exceed before any property tax relief is available. And then above that threshold, a credit kicks in to offset any property taxes due. So for example, if you had a 5% threshold circuit breaker, up to 5% of income, the circuit breaker is not affecting homeowners. Above that threshold, if you're paying 6% of your income, the credit kicks in, it's offsetting 1 percentage point of your property tax bill. If you would be paying 7% of your income in property taxes, it's offsetting 2 percentage points and so on. And again, the purpose there is to target the relief to the people paying the most of their income in property taxes. Now, while circuit breakers have great potential, our research also shows that most states' programs could be greatly strengthened by following a few key best practices. And the first recommendation is to cover homeowners and renters of all ages. Now, unfortunately, this is not currently the norm for states with circuit breakers. Of 30 states with circuit breakers right now, 19 include renters, 11 do not, and just 12 states cover non-elderly households. And this is a problem because we know renters pay property taxes indirectly as part of their rent, and we know that non-elderly households can face heavy property tax burdens and need property tax relief as well. And I'll just note that for renters, states typically include renters in their programs by specifying a percentage of rent that is assumed to be property tax. So for example, a state might assume that 20% of rent is going towards property taxes. So if someone pays $10,000 a year in property taxes, the circuit breakers just assumes that they're paying $2,000 a year in property taxes, and then you just run that through the circuit breaker formula. A second recommendation is to avoid income ceilings and benefit limits that are too low. Again, this is something that is a place where states could make improvements. If you have an income ceiling of, say, just $20,000, the program is going to be excluding a lot of moderate income households that may really need property tax relief. And similarly, if the maximum benefit is set too low, say $200, the program is not going to be able to provide enough relief to the people who really do have heavy tax burdens. A third recommendation is a better way to contain costs, and that is to use a co-payment requirement. Now, for example, if you have a 40% co-payment requirement, what that means is that the circuit breaker is going to offset 60% of the property tax above the threshold, and the homeowner, the taxpayer, will still be paying 40% of the property tax above the threshold. And the purpose here is to make sure that taxpayers who are eligible for the circuit breaker are not completely shielded from any marginal tax increase. They still have some skin in the game. They still have an incentive to scrutinize future tax increases. A fourth recommendation is to use a property tax credit to deliver the circuit breaker benefit to homeowners. Currently, if you look at states with circuit breakers, about a third use an income tax credit to deliver benefits, about a third use a standalone rebate check, and then a third use a property tax credit. And as John said, the advantage of a property tax credit for delivering relief is, first, the benefit is timely, so you don't need to pay your property tax in July and then wait for your income tax refund the next April. And in addition, the circuit breaker relief is much more obviously a property tax relief program. It's not going to be misperceived as a reduction in income taxes. And then a final recommendation is to take steps to promote participation in the program. In practice, many circuit breaker programs have pretty low participation rates. As a ballpark for existing programs, maybe 40% of people who are eligible actually apply and receive tax relief. So it's important to take steps to promote participation, and that includes outreach and advertising to make sure people are actually aware of the program, and then to use a simple application process. And one thing to consider is whether it might actually be possible for New York City to automatically qualify taxpayers, which would, of course, dramatically increase participation rates. So those are some recommendations on circuit breakers. I also want to take a moment to talk about another promising approach to property tax relief, which are property tax deferrals. And with these programs, homeowners are able to defer payment of their property taxes until their home is sold or the owner dies. And at that point, the full amount of deferred taxes is due, typically with interest added. So deferrals are really directly targeted at liquidity problem that homeowners who are housing rich but income poor face by allowing them to tap their home equity to pay their property taxes. And the programs work similarly to a reverse mortgage, except they typically have lower interest rates and significantly lower fees. And eligibility for deferrals is typically limited to low-income seniors, but there are some states that allow younger homeowners to defer tax increases above a certain level, like say the tax increase above 5% from the prior year, or to defer property taxes above a certain percentage of their income, which starts to make the deferral kind of similar to a circuit breaker. And the chief advantage of a with a deferral is that that there's no long-term costs imposed on taxpayers, and this is different from a circuit breaker or really any other type of property tax relief, because ultimately, in the long run, the homeowner themselves will be paying the property taxes. It's just that they're having assistance, a temporary assistance. And so a related advantage there is that deferrals can provide much more substantial tax relief. These programs usually allow homeowners to defer 100% of their tax. But the main problem with deferral programs is that they usually have very low participation rates, often under 1 percentage point. So the common assumption is that seniors are reluctant to put a lien on their home. They want to leave their home free and clear to their heirs. But I'd also note that many of these programs have, there's very low awareness of the program, so people don't know that they're eligible to defer their property taxes. So that's another issue. So because participation is low in deferrals, I would say it's best to pair a deferral program with a circuit breaker, not to choose one approach or the other. They're kind of addressing different issues. And then before concluding, I just wanted to note that with a major property tax reform, it's also important to phase in the reform over several years. Without a phase-in, it's much more likely that reform will trigger a political backlash which could ultimately lead to future policy changes that undercut the reform effort or even result in a less equitable system. And I did a little bit of research into the optimal phase-in period, and I don't think there's obviously any optimal period, but somewhere in the range of 3 to 5 years seems reasonable. And that period reflects the practice in some states that routinely phase in assessments after revaluations. 3 to 5 year period is a typical period that's used for those programs. So to wrap up, I conclude by saying the property tax does have some important strengths as a revenue instrument for local governments, and we want to preserve those strengths, but it's critical to provide property tax relief because the property tax is a tax on an asset value rather than current income. And as I said, the two most cost-effective approaches to property tax relief are circuit breakers and property tax deferrals. And effective circuit breaker programs should cover homeowners and renters of all ages, avoid income ceilings or benefit limits that are too low, use a co-payment requirement, use a property tax credit to deliver the tax relief to homeowners, and promote participation through outreach and a simple application process. And then, as I said, property tax deferrals are a great option in that they have no long-term costs for taxpayers, but because they have very low participation rates, because they don't provide any relief for people who do not already have home equity built up, it's best to pair a circuit breaker with a deferral program. So thank you for your attention, and I'd be happy to take any questions.
Thank you so much. We're going to just move the podium because some folks can't see you, Adam.
Oh, okay.
So,
Yeah.
thanks. One second. So, questions? Alan?
Do most of or any of the states that you've looked at require primary residence as a condition for either of these programs?
Almost all of them do, yeah.
I guess as an economist, how do you pick what's the optimal tax to income ratio?
Well, the question is, when are you
I don't
overburdened?
know how the process is going to be made.
Typically, when you look at circuit breakers around the country, it's often in the range of something like 5%. But I would caution, 5% of what is the important question. And as you design a circuit breaker, it's very important that the measure of income you're using be a broad measure of income. And so it's often the case that states, especially if they deliver their circuit breaker relief through the income tax system, they will not just start with federal AGI or some measure of income such as that, but they'll have taxpayers add in other sources of income that are not counted in AGI. So you've got a comprehensive measure of income that makes the tax relief you're providing a percentage of a very broad-based measure of income rather than a narrow base of income. And that contributes to the fairness of this mechanism. So if you implement it through an income tax, it's easier to do that. There are auditing problems if you're including things in your measure of income that are not on the tax return, of course. So that's an administrative issue to think about. But I would caution, if you're going to use a measure like 5%, there's no magic percentage, right? Overburdened is in the eye of the beholder to some extent, right? That's a political decision as much as anything. But once you decide on a percentage, it's got to be a percentage of a broad base of income.
Yeah. I would can I add a point? Two things to think about. First of all, when thinking about an optimal threshold, if you will, threshold percentage, I'd kind of step back and think about there are at least 4 levers that you have to kind of constrain the overall cost of the program, and that change the distribution of property tax relief. And I would say, it's better to tweak your threshold percentage up or down and your co-payment requirement up or down rather than drop down the income ceiling too low or the maximum benefit too low. So if you have to go to 6% of income to keep the program affordable, that would be better in my view than reducing the maximum benefit, which can end up resulting in people not receiving sufficient relief. And then a second point about the threshold percentage. In my presentation, I was trying to keep it relatively short, but another thing to consider is that there are states that use what's called a multiple threshold approach. And so with that approach, you have a lower threshold percentage applied at lower incomes and then a higher threshold percentage applied at higher incomes. So you may have a 0% threshold up for the first $10,000, no property tax due, and then say 2% of income for the next $10,000 up to $20,000, then 4% of income up to $40,000, and then 6% above that point. And you apply those on an incremental basis, like a graduated income tax. But that's another way to kind of target the relief, and even more so.
Is there a lot of states that do that?
So probably about half of states with threshold programs use multiple thresholds, and then around half use a single threshold.
You had mentioned, Adam, in your presentation, circuit breaker, I guess, for tenants.
Yep.
And if you're using a property tax-based system, how would they get that benefit?
Right. So, as I said, for homeowners, there are some advantages of delivering the circuit breaker benefit as a property tax credit, and that's not possible for renters. So basically, for renters, you can either have a standalone rebate check, you submit an application, you receive a rebate check, or it can be an income tax credit.
There are a lot of words being used here, like sufficient relief and so on. Why don't we just take a step back? Suppose I'm trying to figure out how well the program's working. I want to say, here's what this program's goal is. And then here is how I would measure how well we're doing to that goal. So what would I say is the goal of a circuit breaker program? And what would I use as the metrics to say how well we're doing in getting there?
Well, yeah, I do think that the goal of a circuit breaker really is to prevent households from having to devote too much of their income to property taxes. So if you have no circuit breaker program, there are going to be a few homeowners that might be paying 20% of their income in property taxes or even more. And so the objective is to reduce the number of people paying over some percentage of their income in property taxes. So if everyone participated, the goal would kind of be achieved. There'd be no difficulty engaging. So that's why increasing participation is so important, because again, there are a lot of programs that don't have many people taking advantage of the program, and so that of course is making it less effective.
Yeah.
So I just want to raise a question about what exactly we're talking about when we talk about circuit breakers, because I sometimes get a little confused. There's the issue of circuit breakers to deal with the issue of people of limited means or elderly fixed incomes, where you want to help mitigate the impacts of the property tax on them. And then there's circuit breakers that we've been discussing as part of how to mitigate the impacts of a property tax reform effort that has winners and losers in it. And most of what I assume you guys have been talking about so far are actually property tax circuit breakers of the first type,
right,
not the second type. And I just want to, have us all think through that difference, because it gets to the issue where, Adam, when you were raising most reform efforts, you said you see phase-ins of 3 to 5 years. And that's a conversation about property tax reform and what you would do with circuit breakers as opposed to circuit breakers as a policy matter.
Are there jurisdictions that use circuit breakers to phase in a reform?
I don't know of any.
I'm not familiar.
We like to be unique.
We
It's looking
don't
for pilots.
necessarily.
I was referring to the city, not the commission.
That'll give us a new research opportunity.
I mean, does it make sense to use a circuit breaker for that purpose?
You know, I'm not sure. I wonder, as I said in my presentation, there are some cases where deferrals and circuit breakers start to overlap. And so that, I think, could make sense as a kind of transition or phase-in approach where you defer, or you allow people to defer property taxes over some percentage of their income until they sell their home. So that may make sense.
Yeah, and that would be less complex than having essentially tandem circuit breakers, of the two types you referred to. That would be far more complex than if you had just the traditional type circuit breaker as we addressed, and then a deferral mechanism that takes care of transition households where property taxes go up substantially.
Can I just add to that typology? Can I just follow up on that question, Jacques? I mean, there's a third reason why some people propose circuit breakers, which is my income, my income may be fine. It's not that I need low income relief because I have low income, but all of a sudden my property has become much more valuable. My taxes have gone up more than my budget, right? Are circuit breakers used for that kind of what others might use as a cap? Are circuit breakers used for that purpose? And does that make sense to use them for that purpose?
Absolutely.
Yeah, well, that's the way a circuit breaker works. Your property becomes more valuable, your property taxes go up, assuming the rate, is...
No, but I'm not low income, I'm not paying...
No, it's just...
It's just because it's increasing.
Yeah, relative to your income. So your wealth has gone up relative to your income. That's the distinction we draw, right, between the stock and the flow measure. And a circuit breaker helps address that situation.
But I don't think Adam is talking about having a really high income threshold. You don't want to have it too low, but were you talking about a case where somebody's income might be six-figure?
$200,000, right.
Talking about
Okay.
gentrification.
Right.
Talking about gentrification.
I try to avoid talking
So-
about gentrification, but yes.
Are there cases where a circuit breaker has been provided for incomes in that range?
There are states that don't have income ceilings. And if you think about it, if it's 5% of income and your income is $200,000, that's $10,000 a year. And there are states that have a 10% threshold that's $20,000. So naturally, there's going to be fewer people qualifying the higher up you go in the income scale. But I also think I was more alluding to the fact that there are states that set the income ceiling at $20,000. And I think having it in at least a median income range makes sense. Yeah.
Let me ask you a question. You talk about the tax default program as an option and the low participation in that program. We are about to launch one effective tomorrow in New York City. So can you tell us a little bit about best practice in terms of outreach?
I think it would, I'm not sure. And I don't know that there's any place that's doing it particularly well. I've heard that Colorado and Oregon have relatively higher participation, but it's just relative to other states that are low. I would say it's like outreach for any program. You would just, you would need to have some sort of outreach campaign. You could think about making people aware of the deferral programs when they go in to have help completing their income tax returns. There are programs for that.
How do you get over that basic question that everybody has said?
problem, which is that people don't like the thought that they're putting a lien on their piece of property.
Well, that I think is, you can't get over it. That's a personal decision. And so, there's no, I don't see how you can get over that.
Unless you have no other alternative, right?
Right.
And clearly, if they're not participating, they must feel they've got some other alternative.
Right,
Yeah.
right.
Is the lien always, does the lien always have priority over all other liens? Or is there a different take out?
New York City,
Yeah, that's.
in New York State.
From
So
our,
there's no-
it's a government lien. But
I
from
think
our
it would have-
It's a property
perspective,
tax.
So it has to, so that's not a
For,
point
yeah,
of
for an
variation.
appropriate deferral program, it should have priority, yeah.
But that's part of our problem, is that everything seems reactionary. I mean, we're trying to find a solution that, even with these things in place, we're still in a situation where this doesn't work for everyone, and we don't kind of want to go in the work that we do with council members to inform, you know, property owners in their district. You have a lien sale coming. So it feels like, how do we get to a solution that, even with circuit breakers or SCREE or D or all those things, that we're still in this position of trying to inform people that may still not fit in this criteria, that still are a part of the lien sale, that we don't want them in that position, because I think we've done things to try to accommodate folks, but it's still not enough, because you have some low-income seniors or so forth that can still figure out what to do, but some still not, and I just feel like we're always reactionary to the process, so I think that's what we're looking
But
at.
just back to Carol's point, the only time when it's an issue, the participation rate is an issue vis-a-vis the taxpayer is a deferral issue. I mean, but there's a whole range of issues anyway on a property tax circuit breaker program of participation rates that, you
Oh,
know.
he was talking, he was asking to deferral. I was quite impressed. You mentioned something along the way that we should think about being able to automatically, right?
Yeah.
Make this connection. Could you go into that a little more
And give them the
detail?
option to opt out. In other words, if you meet
Yeah,
certain income threshold or you meet certain age, we automatically enroll you and give you the option to opt out.
The opt-out would be for a deferral, because I don't see why you would want to opt out of a circuit breaker. Because it's like just.
No, I'm talking about
It's for the deferral. So,
I want to get that salted.
so, automatically qualifying people for a deferral, I think, would be controversial. That, you know, but for a circuit breaker,
You're just making a technological connection between their income tax reporting and their property tax reporting?
exactly. Yeah, I kind of put that on the table because I'm interested in whether it's something that New York City could do, because it's really not, I don't know of any program that currently
Does it
automatically
anywhere?
qualifies.
You don't know of anybody who does that anywhere?
Well, and the reason they don't is because circuit breakers are state-run programs, and it's a locally administered property tax, and so it requires a lot of coordination between the
Yes,
state
but
and
we have
local
a local
government.
income tax.
Yeah, yeah.
We have
Right, yeah,
a
exactly.
local income tax.
No, that's why,
Although it's currently administered by.
Yes,
It's administered
but
by the
we
state.
have
Right,
access
you
to
have
all,
to-
but we have access to all the data.
yeah,
So
yeah.
that,
But to some extent, we do it. We currently do it.
I think
She, with senior citizen voters. We currently do a match. We currently do a match of the income and automatically qualify people.
Great.
We currently do it with she.
So the only problem with that is that
It's,
it's probably too low an amount or too?
It's significant for our homeowners.
Okay, so you think that
it's
that's
It's
a-
only for seniors, though.
Yeah,
It's only-
right.
It's only for seniors.
Right.
Don't you also do it with the ITC, you don't automatically qualify them, but you notify them
We
that they
notify them
qualify?
for the ITC.
Notify people that they're qualified.
Well, and
Yeah.
then they have to file an
They have to
amended
file.
return, state and federal,
But still.
to get it.
That's the income
There was a
tax.
time when the city
Yeah, but
prepared
that's
the
income
amended
tax.
returns and
That's
sent
the
it out.
income tax, but for the
Yeah.
senior citizen program that we have for property taxes, we don't, it's automatically done.
Yeah. On the, so you said in the case of circuit breakers that it's best if you cover renters also. Has there been research on, so if you give renters a property tax credit through, as a circuit breaker, the landlord, has an idea of, what their income is, has an idea of whether or not they're receiving a credit. Are there studies that look at what happens to rent in the cases of a renter's circuit breaker? Is there evidence that landlords increase rents more than they otherwise would?
I don't know of any research that's looking at existing circuit breaker programs that include renters. And, typically, it's not a huge percentage of renters who are eligible for these credits. So it would be pretty unlikely to have that much of an impact on rents. But it's not something that's really well established.
Yeah, I think the key issue, as Adam pointed out, is how well targeted is the relief, right? If it's targeted to a relatively small portion of that population, it's unlikely to have a macro effect. But if it's broadly spread across most of the renters, then you might find more of a macro effect on rents. But I'm not aware of any particular research studies on that issue, that narrowly defined.
Also on the renter's credit, so you had cited that it's not unusual for states that have renter eligible circuit breakers to provide the relief on the assumption that 20% of the rent goes toward. Do you know what the range is, and is 20% the median, or is it the average, or both?
The median is, the most typical is 20%, and 15 to 25% is a normal range, but it varies.
May I ask, follow up on that? Why do we involve the property tax in all of this? I mean, I know about people being rent burned. I looked at it. I don't think we know what percentage of that the property tax involves. So why are we just doing a credit for rent burn people and the hell with the property tax?
Well, I think that in theory there's no difference. Like if you have a 5% threshold and you assume 20% of property tax is equivalent to rent, then that's basically saying you're eligible for the benefit if you're paying more than 25% of your income in rent.
Yeah,
so it's pretty straightforward math, but
question.
it makes it so that renters and homeowners in theory are kind of being treated equitably and kind of receiving the same benefit.
It's based on the assumption that the landlord is passing the property tax on to the renter, right? So it's an incidence question.
Which I don't want to go near.
Which, yeah, it depends on the nature of the, how competitive the rental market is. It depends on how sensitive the renters are.
When there's close to zero vacancies and.
Right.
Complicated by the fact that we have a lot of units that are rent stabilized, but there are also a lot that are not stabilized, just subject to the private market.
But also immense land values.
Yep.
It's not mostly tax.
Yeah.
There's improvement here, but immense land values. That complicates it.
There are a couple of things here. I mean, one is when you said because it's very targeted to low-income renters, it might not have more macro effects, but it might very well have in the low-income market, which also determines voucher rates and other things, right? Because of the fair market rents set by HUD. So it could have an effect on that low-income market.
Yeah, you're right.
And do you know of any places that have gone to a renter's credit relatively recently where there's actually been a change, so it could be studied what the effect is on rent?
Not off the top of my head, but I could get back to you on that.
Okay,
We could check. I mean, my experience before going to Nebraska, I was involved in the Michigan state government, and we had a circuit breaker there that assumed 15% of rent was property tax. So that was on a relatively lower end of the scale. scale that Adam's talked about, but that program has existed since the 1970s.
Yeah, but so can I follow up on that also, because some of, I think it was either your property tax circuit breaker report or your 50 state report, I forget which one of the Lincoln, but made the point that actually the studies show that renters in different kinds of buildings, the property tax is passed on more in some kinds of buildings than others. And so in order to actually be getting at what's being taxed up, passed on, you might have to target it to different kinds of buildings. So a 1 to 3 family versus a 6 to 10 unit versus a 50 unit, right? Is that right?
So first of all, I would say, I don't know of any state that does that. And there's probably more of an issue with that in New York City than in a lot of other places. It would become administratively difficult. It's kind of difficult to justify like where you would draw the line in differential treatment. I think in theory, you're absolutely correct that the percentage of rent that is property tax varies a lot across renters. But I don't know of any good way to try to more precisely estimate that percentage for each renter.
So on that point, I want to draw a distinction between two different kinds of problems, right? One is equity between homeowners and renters in that both are paying tax. We know what the homeowners are paying because they're writing a direct check, right? We don't know what the renters are paying because we don't know the incidence exactly, right? So that's one set of problems. So second set of problems is that because in New York, as the Lincoln Institute's surveys show, the effective tax rate on rental buildings is much higher than the effective tax rate on homeownership buildings, right? So renters, or what's being passed on to renters, is at a higher effective tax rate, right? But the circuit breaker shouldn't be used to address that higher effective tax rate problem, right?
No, ideally, you'd like to solve the prior problem.
Yes.
Yes.
First.
The best way to do that would be to correct that imbalance rather than trying to correct it through a circuit breaker.
So, yeah, maybe my introductory comments were too general, but to assure that you get the assessments done properly and you're assessing properties in a fair way, so that you do away with that imbalance between the way properties are being assessed. And solve that problem first and then apply a circuit breaker so that you're not compounding the issue.
I just have another question about that, if I may, which is that your 50-state survey, your 2017 50-state survey, suggests that the effective tax rate in New York for rentals versus home ownership is basically what you call a classification rate of 3.3, that a $1 million commercial property faces an effective tax rate that's 3.3 times higher than a home ownership home, right? Is that comparing apples to apples? Is that sales-based assessment on both, or how is that being calculated?
So
this is beyond circuit breakers, but it's related to this underlying problem.
So I work a little bit on that report, the 50-state property tax comparison study, but I'm not the guy who's really doing the number crunching and knows all those details. But conceptually, that report is trying to compare, a median valued homes in different cities and a building with a $1 million, a commercial property with a $1 million market value. So the assessment method would affect the property tax burden, but not the value of the two buildings. I don't know if I'm explaining that clearly, but
well, I guess the question is, when we think about those effective tax rates and compare them, right, we have to make sure that the homes are valued at the same percentage of their actual market value as the commercial rental buildings or the other commercial buildings, right? You have to be comparing both the effective tax rate and the accuracy of the valuation.
Yeah, both of those things are accounted for.
Yeah, the effective tax rate is the product of the nominal tax rate and the assessment ratio. And so if the assessment ratios differ, you get different effective tax rates. So fundamentally, the assessment practices are critical to making sure your effective tax rates are in line with one
I think
another.
the question's slightly different.
Yeah.
When Council Finance looked at the ratio of Department of Finance market values to sales prices of actual transaction prices, we came up with large Class 2 apartment buildings. We came up with numbers between about 25 and 30%. When we did so for Class 1 homes, what we call market values, we came up with values approximately 1. They tended to be close, give or take the usual range of stuff. So what Department of Finance market values in Class 2, and then you put the assessment ratio on, don't resemble what these buildings will sell for, is the point. And you have to sort of go an extra step. I think that's what you're looking at.
Right, which would suggest that that difference is actually lower, if your figures are correct.
Yeah.
Right.
Yeah.
And that also is an issue when you're talking about commercial properties. Finance produces a market value, but I don't know if you looked at what sales value for Class 4.
What started our discussion was the sale of the Google building, which we found the market value was about a quarter of what it actually sold for, and that's what got us interested.
I mean, it's very clear, finance doesn't put say market value, finance puts in value. That is
Okay,
dictated
my
by the law.
apologies.
That is dictated by the law.
Yes, value, and according to consistency rules, et cetera. This is not a critique of that.
Yeah, of
it's
course,
just
of course.
a critique of.
I just have to clarify, this is not the market value that's produced.
So I'm curious about that same issue. So does the Lincoln Land Institute, when they do these cross-city comparisons or cross-state comparisons, do they make any adjustment to the Class 4 commercial property values in New York?
So this study, it does take into account nominal tax rates, exemptions, the statutory assessment ratio, and then measures of the sales price to the assessed value, the sales ratio. So it should be accounting for that. And I believe that, again, I'm not the guy doing all the number crunching.
Do you use a county-wide ratio, or do you use ratio by?
Yeah, I mean, it would be ideally the ratio in the city for different classes of property. Not all cities have that data available, so it's where the data is available. But I believe that the study coming out in the coming year will better address this issue of the lower sales ratio for the Class 4 properties, and that could make the classification ratio, the discrepancy between the different types of properties in New York smaller relative to other cities. But the issue is not, as far as we know, a problem in other cities.
I want to go back to the deferral program, which we think very highly of. And since, and you're citing a study we like very much, the LAO California study, which
Right,
is very useful. Here we had a very large and rather vigorous debate about the appropriate interest rate. And my colleague Emery would murder me if I didn't ask your thoughts on how we go about getting an appropriate interest rate for a deferral program, since this was a debate between the council and the administration. I'm the correct one.
For a while. I would
time, yes.
Who won?
I think I would say the appropriate interest rate ideally would be something close to the government's interest rate on borrowing plus like 50 basis points to cover administrative costs. So it should be varying over time with the interest rates.
So you're saying when New York City borrows borrow that
See,
in
see,
the bond
see, I was right.
No, no.
That's right. What are we borrowing on at the moment?
He didn't say that, John.
And what are we borrowing
Well,
at the
so
moment?
which, maturity, 10 years?
Term structure.
Short term? Short term?
Yeah, that's about, I think about 6%.
10 years.
We're borrowing at,
I mean,
I don't know the real short terms.
The interest
We're
rate is-
borrowing.
We don't borrow short term, right?
We're borrowing on the fund. And yes, we're not doing any rands at the moment, no. But we're borrowing. So that would have been a bit lower than what we had, what we had reached.
Could I ask a different question? I think I know the answer, but I'm going to ask it just to make sure. My concept, my whole life, and professionally, has been that circuit breakers relate to individuals and households. And in addition, so does this deferral situation. Is there anything, half of our property is, or at least the tax burden is being borne by commercial property. Is there any commercial equivalent of this? Or is it just kind of all up to grabs of what you might do or not do? I did something when I was finance commissioner. I actually changed the way in which, because we were in such a bad recession here, that I actually changed the rules for the way in which a commercial property could make its property tax payments so that it could avoid getting labeled, triggering anything that would label it as bankruptcy. So they pay monthly instead of this, twice a year stuff. Okay, that was within my ability to do it. But I'm curious as to whether there are, in any places, either statutory or formal escape clauses at the commercial property tax end.
So I don't know of any.
That was a long, convoluted question.
Well, so basically, like, are there circuit breaker-like programs for commercial properties?
Right.
I don't know of any. I think you could definitely make a case for deferrals for commercial properties at the very least, so that you're not putting them out of business. You're allowing them to kind of defer that and maybe repay it, down the road in 5 years as opposed to when they sell the property. But I don't know of any jurisdiction that actually does that right now.
I'm not aware of any. I mean, so the incidence question is more interesting with commercial properties, right? Who's really paying that property tax? Is it the customers who buy the products of the commercial enterprise in the form of higher prices? Is it the employees that bear the burden in the form of lower wages? Is it the shareholders if it's a shareholding company in the form of lower dividends? So the whole question of incidence is much more complex in that context. And so it's harder to conceive of a circuit breaker mechanism that would address that question of the burden because it's not clear who's bearing it in the first place.
Well,
I know who pays the tax.
The burden may not be, but the use of the property may be affected, and that may be all the jurisdiction, that may be all that the jurisdiction needs to care about.
Yeah, yeah.
Right? That a property not become abandoned.
Right.
This happened to the city on the residential side, actually, with their own property.
Yeah, absolutely, and it happened hugely in the 1970s, right?
Yeah.
And it may be happening on retail, as we
Yes,
speak, right? Or, so, but couldn't you also structure it that, for example, for small businesses, or based upon the income?
So, yeah, in theory you could.
I mean, they may be renting rather than owning, but.
Yep.
Which gets back to the earlier point
Yeah.
about.
Because the landlord is going to jack up the rent for his
Right
money.
there. It goes up, right?
What do I think about, Mel? We think about circuit breaker, think about renters, and thinking about homeowners. what do I think about in setting my income ranges? I mean, am I thinking about, EITC ranges? Should I be getting into, should I be thinking about getting into, median income in the city? Leave me aside, I'm also thinking about how much money I want to spend. But besides that one, what do I think about, how do I think about where the need is the most and how I target it by way of income on the most need?
So your question is, what would be an appropriate income ceiling for the program?
Income ceiling for the program, right? What would be appropriate income ceiling for the program, or if we're going to do steps, what would be appropriate steps,
Yeah.
forward? But how, or if not, what would be an appropriate one? How would I go about figuring one out?
I don't think that there is a correct answer to the appropriate income ceiling. My view is that it is important to cover median income homeowners at the very least, to not set it at poverty levels or anything like that. And then you can consider the multiple thresholds if you want to kind of direct more property tax relief to lower income homeowners than more middle income homeowners. That's an option as well. But as a short answer, I can't say it's $47,000 or anything specific
But you're
like
saying
that.
it's more like median income, which is fairly high.
I can look like house with renters. I can look at income burden renter ratios by income, right? What the rent burden is or something. There are studies like that. I don't know. I'm just thinking out loud.
But income of the property isn't necessarily income of the owner. You can have two people who
Yeah, that's true.
you can have the income of the property is the same, but as a person who has additional income somewhere else, that wouldn't be necessarily all the income on the property, right? So I could have plenty more income that's not only generated by the property that I'm putting down on my tax return and so forth, which puts me in a different position as a person with far less income, with a comparable property, comparable income on the property. Does that make sense? If you're looking at owners,
But we would be looking at their total income.
total income,
Total
right?
income. We look at their global income, particularly household income.
Exactly.
And then comparing it to either their property tax burden, or if we're looking at renters, we'd be looking at their rent burden.
Right.
Yeah,
But
and then
renter-
figure out
I
where
mean,
to go.
keep in-
Percentage of the rent.
Right.
Percentage
of the rent burden.
Right, keep in mind that in New York City, over half of renters are rent burden,
Right.
right?
Renters, but not owners necessarily.
I
Owners.
understand,
Yeah, yeah.
but it's the renters who are going to come under any low income ceiling.
That's it, yeah.
Mhm.
So that's going to be an issue. So how, can I just ask how this gets established? How do you, if you're a renter, we have no idea how much rent you're paying,
That's fine.
right? So how does that work? I am supposed to get
Yeah.
a rebate or whatever based upon how much of my rent is assumed to be going for property taxes, but we have no idea how much you're paying in rent.
You have to report your rent.
Yeah.
Yeah, you have to
put your rent and income. I mean,
You have to include a copy of your lease.
Squeeze
Copy of the lease.
Squeeze more
Size
similar
lease.
to that kind of scheme. If you create, you have an income for then you provide you the insurance of having the rent, so provide the landlord.
Right, but the opportunity for fraud is
Oh, of course,
substantial,
of course, yeah,
right?
of
So
course.
how do jurisdictions that do this deal with that opportunity for fraud? Or collusion? Doesn't have to be, well, fraud is collusion. Except with the Russians, but, whatever.
I think it's easiest to audit that if the circuit breaker is attached to the income tax mechanism. Then you've got the income data as well. And it's easier to audit that way than if you're delivering that relief through a property tax credit where you may not have the income data in sufficient detail to have the full picture of the income, not only the wage and salary income, but the capital income, the interest, the dividends, the capital gains, and the whole picture that you would get off
Yeah, we're going to
a tax return.
We're going to do the squeeze. We have tax, with the income tax returns and other incomes that you have for documentation.
Right, but we're
So-
talking about something that could go from, I mean, what
No,
what were the
it's-
statistics?
it's-
434,000
Yeah,
people
it's
are
not-
getting
yeah,
the state.
It's a much bigger administration in terms of to manage. You know, if you were to expand it beyond, 58,000 people that we have. Let me ask you a different question. With respect to, there's an article that you published talking about monthly payment.
Yeah.
Can you talk to us a little bit about how this monthly payment improves? Because currently we have quarterly payments for folks, and as part of tax increases, it becomes a more burdensome for them.
Right.
Can you tell us a little bit about your work?
Sure, yeah. So, yeah, last year I published a report on improving the property tax with monthly payments. And, you know, that report kind of started with the observation that there are a lot of people who are financially insecure. Regardless of their income, they're, living paycheck to paycheck. And so a property tax liability is pretty high compared to, what people can pay if they haven't saved in advance for their property taxes. And so the way property taxes are billed in most places, once, twice, maybe 4 times a year, is kind of creating an unnecessary problem. Like you can imagine what would happen with the mortgage delinquency rate if people just paid their mortgages once or twice per year. So there are places in the U.S. that allow people to pay their property taxes monthly. The leader in that regard is Milwaukee, Wisconsin. In Milwaukee, everyone's tax bill has the option to pay your full property tax bill for the year or the first monthly payment, and then you get enrolled in their monthly installment plan. And then there are other places that allow people to apply to prepay their property taxes on a monthly basis. That's done in all the largest counties in Ohio, so Columbus, Cincinnati, Cleveland. That's done in Indianapolis, Austin. From my perspective, in talking with treasurers around the country, it's a really good service to provide to taxpayers. There's a little bit of a temporary challenge setting it up, but once it's set up, it's pretty much all automated, and it benefits some taxpayers, and it doesn't really have any costs for the government.
How do you prevent the government from spending the money too early?
Actually, we collect it on forehead now.
Yeah.
They will collect it on forehead.
Yeah.
Well,
Right, but if
You don't spend it until the end, right? You don't spend it until like
We
2
will
years
collect
later.
it later.
local government units.
So we're not going to spend it prior.
Goes into the bank account.
Local government units already smooth this with tax anticipation notes and mechanisms like that, so.
Yeah, I would actually turn that question on its head and say that the ability to spend it immediately does have some benefits. You don't need to be having short-term borrowing to cover your payroll because your property tax revenue is only coming in twice per year. So I don't think it's a problem. I actually think that there are some benefits of that ability to have revenue coming in more regularly.
So can I ask, actually, 2 questions about the circuit, to go back to the circuit breaker. You mentioned, I think it was Adam, you mentioned that some circuit breaker systems are not just based upon an income ceiling, but also a net worth ceiling. And we do have data that where a surprisingly large number of people own a home and are paying property taxes but report 0 income, which signals that they have some net worth that they're paying it out of, right? So how are those systems administered?
So
Again, you don't know their net worth from their income tax returns.
right. So I think John was.
I mentioned that.
Yeah.
Oh, sorry, John.
Yeah.
I apologize.
And I'm not aware of circuit breakers that have a net worth limitation to them, but I wanted to suggest that idea because it's my presumption that that's a significant issue in the city. So you're quite right. People that have a great deal of wealth, but no income, right? And so we're back to the question of how to deal with that, whether through deferral or some other mechanism. It's, they're quite wealthy, but, no current income flow. And so the question is how do you require them to divest of some of the wealth in order to pay the obligations, or do you defer those obligations and get your taxes with interest when the property is transferred? So it's a question for you. If you want to establish a circuit breaker mechanism, do you want only an income limitation, or do you want to couple it with some kind of a net worth or a real estate asset value limitation as well?
So there are a few states that have net worth tests. It's not very common. I would say probably under 5. And I'm kind of wary of a net worth test just because it's.
Net worth to me, is it directly the property value?
No, it goes beyond that. It would include all their financial assets. Yes, that's the problem. It's administratively very difficult.
So what are the,
well,
so there are states that actually do that?
there are some states that have net worth tests, and I talked earlier about low participation rates. I think that makes participation even lower. I think that a middle ground is to have a limit on the assessed value of the property, which you obviously know, or at the very least to only consider property tax on some maximum value. So, if you set the maximum value considered in the circuit breaker formula as, say, $500,000, you allow people above that to be eligible, but if their effective tax rate is 1% and their home's worth $800,000, it's treating them as if their property tax bill is $5,000 because you're capping the property value considered.
And I'm thinking maybe this is more typical or started in sort of farm states where you're really that's all you're dealing with is a piece of land. Right?
Yeah.
It's really easy to get, and the value's on the card, and that's all there is.
Right.
But I'm not sure how you do it here.
Yeah, so I think property value, assessed value, would be correlated with overall net worth, and it is much easier to measure, as Adam said, than property value.
I don't know that I would want to use circuit breaker money for someone owning a $5 million brownstone in the West Village, no matter what their income is. Was? Yeah. I don't know that that's a good use. That's an asset that's worth so much that it's probably not a good use of public money. So maybe we do need a property value test.
Yeah. But you certainly wouldn't have a problem with if they were cash poor with deferral.
That's right. They could do deferral. That's right.
And then just borrowing against the asset.
And how long?
Till they die or the property transfer.
Until they sell the
Whenever
asset.
the property is transferred.
The city's getting the money, the city's getting it with interest.
20, 30 years.
Well, while we're talking about interesting ideas like time to network, relatively untested, are there any places that require landlords to disclose how much they are passing on to the tenant in taxes? So one question would be, a major issue about renters, of course, is that renters don't think they pay property taxes because they don't actually see the bill. So they don't necessarily vote as if they paid property taxes, even though they do. So one issue would be, should we be requiring landlords to say on their rent bill, X amount of this is going to pay your property taxes?
So, so I just had to check our report, and Arizona and Vermont ask landlords to allocate a portion of the total property tax bill for the building to each individual unit. So those are two states that kind of try to get at that.
So does that information get passed on to the tenant?
I'm not sure, but I would think it would be.
Cooperatives do it for tax purposes, right here.
Right.
Yeah.
So it's doable.
Yeah.
But you can go closer to that, that's a whole different.
That's the point.
Well, the co-ops can divide by share. It would be
Right, they
more
divide by share,
complicated
right.
for a rental building
Actually,
to
that's true.
divide,
Yeah.
right?
Yeah.
But even if you had a rough justice of dividing by the number of units, it would still be more information to the tenants than they now have. Right. Is there a concern that with tax credits for circuit breakers for renters, that renters become less tax salient? They demand more services because they're not, now they're getting that, they're actually getting a before they didn't even believe they were paying property taxes, but now they think they're actually getting a rebate.
Demand a higher rebate. That's what they meant.
Because of the circuit breaker?
Right.
I don't know. I don't have a good answer.
That's a really interesting question. So, yeah, it may make the tax more salient and therefore elicit some response from them. I'm not aware of any tax salient studies related to that issue, right? The tax salient studies typically apply to excise taxes and sales taxes and those types of things. I'm not aware of research on that particular aspect of tax salience, but it's an interesting idea.
That would
We're giving you a research agenda.
Yeah.
I would say that would only come across, one, if renters knew exactly how much of their rent was applied to property taxes, and two, if there was a benefit to the owners, they wouldn't necessarily pass it along to the renters. They would just kind of either bank it or, so knowing that wouldn't necessarily translate into renters getting some sort of benefit.
But the renter might think,
Maybe.
20% of my taxes, 20% of my rent is going to taxes, and I'm getting a refund of that. So I want better schools, I want an MTA that works, I want things like that. So I'm going to vote for the people who, like, that would be that's the issue.
That's a selling point for the idea.
Translate that into the larger.
People are more civically engaged.
Yeah, maybe.
So,
I don't know if they.
yeah, I mean, just a couple of general reflections. In general, renters have pretty low awareness of, the fact that they are paying property taxes, but their rent is very salient. And so, I just, let me think this through. I don't think that it would necessarily cause renters to support higher taxes because, if it allowed the landlord to change their rent, that's kind of what they would be sensitive to. I don't know that they would make the connection to the level of taxes that they want to support. I'd have to think about it a bit more.
Although that issue exists, like for homeowners, for example, where they pay a separate school tax.
Yeah.
Right, so they get to see that, well, my school tax went up, but that's something I want to go up this year, as opposed to the general government. And so you have homeowners that see that and act on it sometimes, right?
I mean,
You get to vote on the budget, the school budget too.
Right.
I don't think renters pay any attention to that with regards to their rent.
well, they can't because they don't know.
But beyond that, I think they compare themselves to other renters in the market as opposed to other.
Taxpayer.
Yes, right. So they said if I'm paying $1,400 versus $1,600, they're not really looking at the property itself and whether that property has any breaks. They're just comparing themselves to other renters and whether it seems comparable.
Most renters don't understand part of what they're paying is going to all kinds of taxes.
I don't think that they don't understand, I don't think they know what it is, and I don't think it dictates whether they decide to pay, this.
They know they're paying some taxes.
I can tell you that I taught a seminar on New York City fiscal crisis with 25 of the brightest law students in the nation. And to the person, they argued that they did not pay property taxes in their homes. So maybe law students are particularly dumb on that issue.
You must have had housing included in their stipends or something.
But the point is, we're looking for ways to increase the salience, both because if we were to recommend a renter's tax credit, we would also want that to be salient, right? So can we go back to the phase-in or the transition based upon tax reform for a minute, unless there are other questions about the circuit breakers. So are there any states that you would, or places that you would point us to that have done a significant tax reform and have done a good job of phasing that in?
So I looked into this a little bit prior to this meeting, and I could not find anything that I would point to.
We're on our own.
You mentioned earlier, maybe not tax reform, but you mentioned earlier.
Assessment cycles.
Tax, evaluation adjustments.
Right.
Right, so I mean.
With 3 to 5 year phases, right?
Yeah, that was like the best data point I could find. And there are phase-ins for other types of tax reforms, particularly income tax return reforms that are phased in at the state level. And, the lessons there could be, you could draw some lessons from the approach they take.
Adam, what about some of the research that's been done on Pittsburgh in particular that went from their split rate tax to a uniform tax? And there was a full reassessment done as part of that. And Lincoln's got some research papers on that, where about Schwab and so on. So Pittsburgh might be an example. Now, they did this some years ago, but they abandoned their split rate tax, which they had previously with a higher rate on land relative to improvements, and they went to a uniform single rate tax. But as I understand the process, it was driven by a citywide reassessment which had not occurred for nearly a century. So the assessed values were way out of line. So they didn't abandon the split rate tax just because it was not performing well. It was because of the massive reassessment that went on. It's the only example I can think of a major change in a city's property tax regime that we might be able to look at for some
Wasn't there one in
lessons.
Chicago a number of years back that turned out that they never, the assessors said they did a tax reform and then turned out they never implemented it, but they didn't tell anyone?
I don't know about that.
I don't know.
When was the Boston? That won't happen. It was Lincoln Land at Boston.
Sure.
Boston. That's what the classic.
So now that's a good example. So Massachusetts as a whole had a property tax reform in the early 80s.
About 2.5.
2.5.
Prop 2.5 was part of that, but there was also a court case that mandated them going to full market value assessments. And that was phased in over several years. And that's also when they adopted a classification system so that they, were able to, be taxing at full market value, but not have as big of a tax shift as you might have if you had a single tax rate.
To my colleagues, Lincoln Land has on their website a series of, 3 videos that are the lessons that were derived from the Boston, from the Massachusetts evaluation. I found it useful.
Will you send it on to us?
I'll pass you links. Yeah, I'll send links.
So one of the recommendations that you make about property tax circuit breakers is that the funding for it come from the state, which we're all in favor of.
Total agreement.
But are there reasons other than the local government saving money? Are there more efficiency reasons to do that?
So I think that for the majority of governments that are not like New York City, and for states, there's fiscal disparities. And so you think about New York State as a whole, places like, there are a lot of places that are poor that could not afford a circuit breaker on their own, and so state funding is important to make sure that people can get property tax relief, regardless of whether they're in a wealthy jurisdiction or a poor jurisdiction. I think for New York City, the city's, has some similarities to a state, in its size and its revenue structure. So it's less of an issue than every other state that we've looked at in this report. We're talking about statewide circuit breaker programs. And so it's an equity issue to make sure that you're kind of addressing the fiscal disparities across hundreds of governments.
Right, and the opposite of that would be subsidizing the tax breaks out of New York City if you look at it from a relative wealth perspective.
If the state offered circuit breakers for everybody, but they don't, or, well, yes, I get it.
So, in any case, the reason we suggest state funding has to do with fiscal disparities.
Okay, not who should redistribute, et cetera. Got it. Okay, so any other questions, concerns, or any other advice that you have for us? So, again,
I bet you're glad you're not sitting here.
Any other advice for us?
Yeah. No, I mean, for myself, speaking about circuit breakers, deferrals, phase-ins, monthly property tax, I think we covered those issues.
I'm sorry, I just have one more on referrals, I apologize. But on referrals, do the states or the local jurisdictions that are giving deferrals look into the reverse mortgage problems and, how do you?
So the reverse mortgage problem, can you elaborate what you mean? Just
Well, there's a lot of concern among homeowners that reverse mortgages are fraudulent, et cetera. And so I'm worried about how that affects the take-up of deferral programs, but I'm also worried about, just how you market it. There are successful reverse mortgage companies who have cracked the marketing nut. I'm not entirely sure that we want to model ourselves after them.
Right. So I would say, on the one hand, the fact that some reverse mortgages are not necessarily consumer friendly can make a good deferral program much more appealing. And then just the second point I would make is that cities typically do have restrictions on whether you can get a deferral if you have a reverse mortgage, or in some cases any sort of second mortgage of any sort on the home.
It's really a question of market failure, right? Why does the financial market not provide this mechanism in a more reasonable way? And I don't know the answer to the question,
And
but
why does it fall to government to have to?
right.
Yeah.
Why doesn't the private market handle this problem? That would be worth some research to try to figure out where's the market failure there.
Okay, any other questions, comments, or advice? Good luck.
Okay.
Thank you very much.
Thank you.
for
Thank
all of
Thank you,
this.
that was useful.
Super helpful.
Yeah.
Super helpful.
Right.